Welcome to Second Take, the show that focuses on the issues behind the news. State Freight Logistics Group Transnet unveiled details of its R300 billion 7-year investment program earlier this week. Terence Creamer joins me to discuss some of the highlights. Terence, welcome to Second Take. Could you give us a bit of insight into Transnet's market demand strategy?
Well, the big number is the 300 billion that's going to be spent over the 7-year period from now until 2019. But behind that number is some big volume increases. We've had the 180 billion that was spent over the previous 7 years. So we've been in an investment cycle from Transnet, and prior to that there was a big investment drought within the group. So that investment was very much about catch-up. And the next, so I'd say 60% of that investment was about catch-up investment and maintenance. But the market demand strategy is really about growth. So the 60%, it's switched around, is going to be about expansionary investments. And this is mostly around rail and then ports and pipelines, with ports being the second big chunk of it. So about 200 billion of this goes into the rail sector. And that's really to build in new infrastructure, but it's already about the commodity lines. And it's big numbers again. We're going to be raising from around 68 million tonnes a year on the coal line to over 98 million tonnes by 2019, which is above what we currently export through the Richards Bay Coal Terminal. And similarly with iron ore, 53 million tonnes to 83 million tonnes, big jump. And then a sort of a quantum leap almost in the general freight business, which includes things like manganese, but looking to go from 80 million tonnes currently to 170 million tonnes over the period. And a lot of that will also be containers and big growth in automotive transport. So there are big numbers behind this big 300 billion. And it's definitely going to be a game changer for Transnet in the sense that its revenues are going to increase materially. Its employee numbers, in fact, are going to go up by 15,000 people net. That's after natural attrition. So probably 19,000 people will be employed in Transnet over these next 7 years. And that's going to take their employee numbers all the way up to 74,000 people. And then obviously for the South African economy, there's a lot of potential to supply into this big program with 1,000 locomotives to be procured. And that's over and above the locomotives that have already been bought by Transnet over the previous cycle. And we're looking at serious investments around the ports, tandem lift cranes, etc. So it's a big investment program, and they're saying that close to 600,000 job opportunities are going to be created around this program. And I think government's also very keen to have a lot of localization and a manufacturing revival around Transnet's investment program.
Again, there's very little in the plan for delivery by the private sector. Why do you think is that?
Well, I think it's where we are as a country. It was, at one stage when public enterprises were set up, these were all destined to be privatized. But there's been a change in policy and a change in thinking around a lot of these state-owned enterprises, whether it's Eskom, Transnet, or the rest, but especially the two big ones, Eskom and Transnet. And we're really in a phase where government is wanting to use these state-owned enterprises as the shareholder to deliver on its developmental state objectives. So yes, I think again there will be disappointment that there's this big investment program into infrastructure and that there won't be any role or material role for the private sector. We see a marginal role with the concessioning of the branch lines, and I think when some of the port terminals come up, there will be a contest for who gets some of those port terminals and the ability to operate those. But at this stage, it's fairly small within the bigger picture. But what we are seeing is, what we're hearing is that there's going to be a revision of the private sector participation strategy. Now, that was a big part of the previous regime at Transnet's vision, to bring in private sector and to have a bigger role for them. But as I said, things have changed and there's a different view from the shareholder and the policymakers at the moment. But they are looking at it, reformulating that private sector participation and crowding in over and above the 300 billion. We understand they're looking at crowding in private sector participation of up to 150 billion, which would make this program that much larger and that much probably more effective and that much more exciting for the private sector. And I think the focus of that is probably going to be the dig-out port at Durban, which is at the Durban International Airport site, where the land is now in the process of being acquired from AXA, and it's a deal of 1.8 billion has been struck between the two state-owned companies. And I think that Transnet realizes that that project, which is going to probably start at 50 billion and grow well beyond that as the thing evolves over the many years, needs to have private sector participation. So I think what we'll see is a contest, especially for the land side, the operation of the terminals. So probably the Transnet National Ports Authority will remain the landlord, but we'll see a contest, and not just Transnet port terminals getting all the above ground operations. So that could be interesting for the private sector. It could crowd in quite a lot of investment money, and I think it could be quite exciting if we have two ports in very close proximity that aren't operated by a monopoly anymore. So we'll have maybe Transnet port terminals operating the old Durban harbour, which is the biggest in the country, and then in a few kilometres down the road at the Durban International Airport site, we might have private sector operators competing with that port, which I think is really what we need to bring into the system, some rivalry.
Do you think the plan contains any risk for Transnet, and more importantly for South Africa?
Well, I think for South Africa that is the worry. If you have a near monopoly business rolling out such a massive investment program, are you crowding in the private sector? Are you taking in the people that are going to use it and benefit it are clearly private sector. It's the mining industry, the automotive companies. But are you really engineering these things in an optimal way? Are you doing this in a commercially driven, commercially sensitive way, or are you looking at a lot of developmental impacts? Now, I think government wants both, and Transnet is having to walk this tightrope of both, and I think the country probably does need both. But it is a risk, because you can have projects that go ahead that aren't optimally designed or over-engineered because you're a monopoly. And I think Brian Molefe admitted that in some ways the pipeline project, which rose from like a 9.5 billion figure to over 21 billion, was an example of what can happen, and also has elements of over-engineering in it. And we see it with the contest for the manganese terminal at the moment. Should it go west out of Saldanha Bay, or should it go south out of Pucha? Well, Transnet's made the decision along with the shareholder that it's going to go down south. And the manganese miners are not overly impressed by that decision. And similarly, is the Swaziland link the right thing? It fits in with regional integration, but is it the correct strategically? These are all things, if there was more rivalry in the system and we had a contest for projects, I think the best, most commercially sensible one would prevail. But we're not in that space. We're not going to be privatizing these enterprises anytime soon. We're not going to be breaking them up, I don't think, anytime soon, although that was raised as one of the risks to Transnet. Should there be a regulatory or policy change, and that the policy makers decide that we do need vertical separation, for instance, within Transnet, and exclude assets from Transnet, for instance, separating the railway lines from the railway operations, could have a massive impact on their balance sheet and their ability to fund this project. So that's a risk for Transnet. But at this stage, I don't think that is the major material risk. It's more whether these projects will be properly selected, whether they'll be optimal in terms of delivering economic value for the country, as well as, I think, at this stage, the developmental impact, which will come. The sustainability of projects relies on their commercial viability. So the developmental impact is really only there if these things remain commercially viable. So there is that risk for South Africa. For Transnet, it's really, as I said, the policy environment could change. The regulators also have to decide whether they agree that Transnet can effectively pre-fund these projects using their tariffs. And they were quite open, I think, in when they unveiled the strategy, that they're going to be looking at tariffs at inflation, CPI, not PPI, CPI plus 2%. And that, I think, is going to be a contested terrain. Really, we saw the energy regulator didn't appreciate that approach with the pipelines project. And I think we've seen now that a lot of the funding is having to come, we're seeing quite steep increases as the assets are introduced. So there is a downside risk to that as well. But the fact that users and the country has to pay for Transnet to build this up front through the tariffs. Okay, 100 billion of this is also coming from the debt capital markets, and the tariffs are a very important signal for lenders that they're going to get their money back. So there's also downside risk if we don't have tariff increases that are reasonable. But I think that is a risk if the regulators say no way, you can't do this. Transnet will have to look at a different funding model for its project. But I think that on the whole, Transnet has built some resilience on its balance sheet, and it will probably be able to raise the funds it needs. And then obviously the last risk is, will they be able to implement? South Africa's state-owned companies haven't had a brilliant record of delivering on time and on budget, the multi-product pipeline being a case in point. And if these things do go over budget and are delayed, and we do, for instance, eventually have growth in this economy, again, Transnet will be seen as the constraint and the bottleneck. At the moment, I think that the economic risks are on the other side, that the demand could fall because of the prevailing headwinds from the global economy, and still that we're battling to revive our productive sectors. So I think there are risks to Transnet, but I think the more serious risks are really to South Africa. Are these projects going to be delivered on time, on budget? And are they sustainable in the sense that they are really commercially well founded and have strong foundations, in terms of being able to satisfy real demand? Or are they going to be white elephants?
Terence, thank you very much. That is the Second Take show for this week. Thank you for watching, and join us again next time for more news analysis.